Hello and welcome to Unacademy IAS. RBI, along with the Government of India, have announced a set of reforms to address the depreciating rupee as well as bring in foreign investments into India. Let's decode all of them. But before I start, here is a very important announcement for those who are starting the UPSC 2027 preparation. The Unacademy Plus now is made affordable to you. The price is 19,999 and the Unacademy Iconic is also available at a 50% discount priced at 29,999. Once you enroll into Unacademy Iconic, you will get 14 hard copies of the books, 1:1 mentorship services, URTS and MRTS, and also sessions with UPSC toppers. And this is available only for the first 1,000 students who enroll into this particular course. Those interested in enrolling, do check out the details by clicking on the link provided in the description below. And whatever is the price mentioned in the website, use the code IAS English. Let me begin the session now. The Indian rupee since the start of 2026 has depreciated by more than 6%. And along with this, because of uncertainty, volatility in the international market, which is being caused because of the conflict in West Asia, more than $26 billion worth of foreign investments have gone out of India. In order to address these particular problems, the government as well as the Reserve Bank of India have announced a set of reforms. Let's decode them one by one. Starting with the first and the most important one, capital gains tax. Now, the foreign portfolio investors, when they invest in government securities, they will make the earnings under two heads. One is the interest income, and the second one is you buy at lesser price and you sell it at higher price. That is capital gains. The government until now imposed a tax on the interest income as well as the capital gains. On the interest income, the government imposed and collected 20% taxes, and on the capital gains, if it was the short-term capital gains, the government imposed tax of 30%, and if it was a long-term capital gains, the government imposed 12.5% tax. And the taxes are not yet over. In addition to this, the FPIs paid surcharges which were in the range of 2% to 37%, and also the healthcare education cess which was 4%. So if you put together all these taxes, the overall tax liability on the FPIs was very high, one of the highest in the global market. Now, what is the change announced by the government of India? The government has announced that all these taxes will be exempted retrospectively from 1st April 2026. Retrospectively from 1st April 2026, these particular taxes will be exempted, which means from 1st April 2026, if FPIs have invested in India, they do not have to pay these particular taxes. Now, what is the impact of all the reforms? Let's evaluate after me covering all the reforms one by one. Second one, FCNR deposits, foreign currency non-resident B accounts or deposits. These are basically the types of deposits which are held by the foreign depositors. Now, what are the types of foreign depositors covered under this? We basically cover the deposits which are kept by NRIs, the deposits which are kept by overseas citizens of India, OCI, and PIO, person of Indian origin. So these types of investors are allowed to hold deposits with commercial banks in India. Now, the specialty of these particular deposits is that one, whatever interest is earned, the interest is exempted. Interest is exempted. The foreign investors don't have to pay any taxes on this. Second, the exchange rate risk in case of these particular deposits is borne by the banks. What is the meaning? Let me explain this with a simple example. Let's say today, the NRI will deposit $1,000 under FCNR deposit for a duration of 3 years with a commercial bank. And the exchange rate today was, imagine $1 is equal to 90 rupees. hypothetically. I know it is not 90 rupees right now. Upon the maturity, if $1 becomes is equal to 97 rupees, the bank which has collected dollars has converted these particular dollars into rupees for lending purposes, etc. Now, basically, when they collected for every dollar 90 rupees. Now the bank has to pay for every dollar 97 rupees, which is exchange rate risk. And in case of the FCNRB deposits, the exchange rate risk is borne by the banks. So the banks are worried. In addition to the interest rate that I will have to pay again in foreign currencies, I will also have to pay for basically this particular exchange rate risk. So generally what the banks do is they will enter into contracts to hedge the risk. They will basically enter into agreements or contracts to hedge or escape from this kind of an exchange rate risk. And that happens under the derivatives market. But the problem is very simple. When you enter into these agreements or contracts, you will incur certain expenditure for this as well. So the Reserve Bank of India now says this expenditure for hedging or basically protecting themselves that the banks will incur, the Reserve Bank of India will bear it, will basically take care of it, which essentially will make these particular deposits, that is the cost associated with these deposits, lower for the banks. Now the banks will be able to collect more and more deposits under FCNRB accounts. In addition to this, there is one more very important feature associated with FCNRB. These deposits are not covered under the guidelines of CRR and SLR, cash reserve ratio and statutory liquidity ratio, which essentially further lowers the cost that the bank incurs associated with these particular deposits. So this is another very important reform. Third very important measure, fully accessible route or FAR. Now what is this idea? The foreign portfolio investors, these are allowed to bring in money into India and invest in government securities. There are different routes. There is a general route, there is voluntary retention route, and in addition to this, there is also a fully accessible route. Under the fully accessible route, now the kind of government bonds which are notified by the RBI, which are covered under this route by RBI, now the coverage of the instruments has been expanded. The government bonds with maturity 15 years, 30 years and 40 years will be covered under FAR. And the benefit of FAR is that the foreign investor do not have to basically stick to the guidelines or thresholds or the restrictions which are generally very strict, much more stringent under the general route. So the government bonds of 15, 30 and 40 years now have been included under FAR. In addition to this, the sovereign green bonds which will be issued going forward and with maturity period of 5 years, 7, 10, 15, 30 and 40. These particular sovereign green bonds will also be covered under the fully accessible route. This is one more very important reform. Now before I go on to the next one more very important point in the context of FCNRB accounts so that there is no confusion. I said Reserve Bank of India will cover the hedging cost associated with these particular deposits which are collected by the banks. But what kind of deposits? Those deposits which will be collected till 30th September and these deposits which have maturity period of 3 to 5 years. This is a very important point. Please remember this. Now, next, concessional Forex swap window for PSU ECB. The two technical terms is PSU ECB and Forex swap window. Let's start. The public sector undertakings will require a lot of money to spend on, let's say, infrastructure or capital formation. But the problem is the borrowings that they do from the domestic market, the rate of interest on that could be higher. So these are allowed to borrow from the external market under the route called as external commercial borrowings, ECB. Very recently, Reserve Bank of India has made a change in terms of borrowing limits under the ECB that is commonly applicable for all the borrowers. From $750 million, that was a restriction, it has been increased to $1 billion or up to 300% of the net worth of the company. So under this, entities, commercial entities, including PSUs, they are allowed to borrow from the external market, either in the form of issuing a bond in the external market or in the form of, let's say, taking a loan from a commercial bank but from external market. The benefit is these entities will be able to borrow at lower rate of interest. Lower rate of interest. But the same problem is faced by the public sector undertakings. That is, imagine you borrow when the exchange rate is $1 is equal to 90 rupees, and you'll have to repay when the exchange rate is $1 is equal to, let's say, 95 rupees. And again, I'm taking hypothetical exchange rates here. So don't you think when the rupee depreciates like this, the PSUs will come under pressure of repayment? That is, they will have to pay higher in the form of rupees. In order to provide protection to the public sector undertakings, the Reserve Bank of India has extended the concessional forex swap window facility. Under this, RBI simply says, whatever assistance I'm providing to the banks under the FCNR deposit scheme, same benefit I will extend even to the public sector undertakings. With this, what is expected is very simple. The public sector undertakings will borrow more front load. Front load means rather than borrowing later in the year or in the next let's say quarter or the fourth quarter of the current financial year, they will front load the borrowing in order to get the benefit of this facility announced by Reserve Bank of India. And annually, the public sector undertakings generally borrow more than $10 billion under the ECB route. Now, the fifth very important reform is portfolio investment scheme. Portfolio investment scheme. Earlier, when the budget was announced by the government of India, the finance minister had made the announcement. And this particular announcement now has been notified, operationalized by Reserve Bank of India. Now, what is this idea for portfolio investment scheme? Under this, certain investors such as NRIs, the OCIs, along with PROIs, that is person resident outside India. These kind of investors are allowed to invest in the stocks of listed companies. In the stocks of listed companies. Now, until very recently, individually, these investors were allowed to own up to 5% of a listed company's paid up capital, that is 5% of the total shares. The announcement was that this will be increased from 5% to 10%, and cumulatively put together in a particular company, how much can be held under this particular scheme by the foreign investors? Until very recently, it was limited to 10%. This has been now increased to 24%. So this has been notified by Reserve Bank of India. Now let's summarize what is expected impact because of these particular 5 reforms. Like I said earlier, Indian rupee is experiencing a downward pressure. It is experiencing depreciation. With these kind of reforms announced by the government as well as the Reserve Bank of India, we are expecting huge inflows of foreign currencies into India. The problem has been that historically, when you see, there is outflow of currencies under the current account because we tend to have a current account deficit. But in order to bridge the current account deficit, we generally experience a surplus under the capital account. But in recent times, because of the volatility in the international market, etc., there is outflow under the capital account as well. For example, in the last couple of months, you must have come across a statement or the newspaper headlines that net FDI has turned negative in India. So, in order to address these particular problems, bring in more and more dollars into India, basically the government of India as well as the Reserve Bank of India have announced these set of reforms. This is expected to bring in more than 40 to 50 billion dollars in the coming days. That is the first. So first impact is inflow of dollars into India. Second, with inflow of dollars, the rupee value is expected to stabilize. Rupee value is expected to stabilize. But in addition to this, there is also one more very important objective: inflation. Whenever rupee depreciates, India being a net importer, there will be there will be an impact on Indian economy and a common man such as you and me, because a lot of these imports are priced in dollar, and with rupee depreciation the imports become costly, which will contribute to imported inflation. Now, by addressing the problem of rupee depreciation, the Reserve Bank of India is also trying to address the problem of inflation that is caused because of imports. In addition to this, one more very important objective: there is a concept called as global bond indices. The inclusion of government bonds in the global bond indices has been held because of the citing of many of these particular restrictions which are imposed by the government as well as RBI. By loosening, by withdrawing or deregulating these particular restrictions, we are making it much more easier for the foreign investors to invest in India. And with this, we expect the argument of Government of India regarding the inclusion of the government bonds will become stronger in the global bond indices. And once more and more indices will basically include the government bonds, the foreign investors, which are basically the indexed investors, because the inclusion of government bonds has taken place, they will bring in lot of money into India, which will further boost the value of Indian rupee, add to the foreign currencies, the inflow of foreign currencies into Indian market. So these are some of the expected outcomes of these set of reforms announced by the Reserve Bank of India as well as Government of India. So this is basically what I wanted to discuss regarding the set of reforms announced very recently. If you have liked the session, do not forget to hit the like button. If you're yet to join the Unacademy IAS YouTube channel, kindly do it right now. Thank you. Have a great day.